So how do bonds work step by step? Because bonds are a common investment, but for many investors they remain a mystery. So let's break it down how bonds work and how they can benefit you in the long run. If you take a moment to watch this video, you will gain a clear understanding of this straightforward investment option, really simple. So let's begin. A bond is essentially a loan that you provide to an issuer, such as a government or a company. And in return, the issuer promises to repay you the borrowed money on a predetermined date known as the bond's maturity date, along with interest paid every single period during the bond's term. So let's illustrate this with an easy example. Are you ready? So when you purchase a bond, you are lending money to an issuer for a specific period. Let's say investor A buys a bond for $1,000 in the year 2024 from the German government with a fixed coupon interest rate of 5% for a term of 5 years. So the German government guarantees to repay investor A the borrowed amount of money from $1,000 in 2029 plus an annual interest of 5%. So effectively, you are lending your money for a fixed period. But what risk do you face with a bond? And what guarantees do you have? There are two risks to keep an eye on. The first risk is that the German government may go bankrupt in the meantime. This is why a bond has a credit score or a rating. So each company or government bond is assigned a rating. And this rating is an assessment of the issuer's reliability, often expressed as a grade. It provides an estimate of the likelihood that the issuer will fulfill its obligations, allowing investors to know how safe their investment is. There are three well-known companies such as Moody's, S&P, and Fitch that assess the creditworthiness. And it looks like this. So the highest rating is AAA with countries like Netherlands, Germany, Sweden, or for example Finland. And then the rating drops to a double A to an A, and from triple B to double B to single B, and then drops to C where D is bankrupt. These ratings apply to longer term bonds, and there are different ratings are used for short-term debt securities. So that's the first risk you need to consider when you are buying bonds. So if you lend your money to a creditworthy country like Sweden or Finland, for example, the chances are high that you will get your money back. But if you lend your money to a country with a double B rating, the chances are less that you will get your money back, right? But should you only lend your money to a creditworthy company? That's correct. But this would mean that less creditworthy companies would lose interest, right? So what happens next? So less creditworthy companies or countries therefore compensate with a higher interest rate to make it attractive for the investor. So if you borrow money from a less creditworthy company, you generally get a higher interest rate. So the higher the risk you take, the more interest you get paid. And then the less important fact about a bond, because this is the issue that many investors encounter and struggle to understand, but it's quite simple. So imagine this, investors A and B both buy a bond for $1,000. That's the amount they will receive at the end of the period. But after purchasing their bonds, they can decide to sell them to the next investor in the meantime. So let's say the interest rates rises after they have purchased the bond, and the bond of investor A always yields 5% interest per year, but a new loan comes out offering a 6% with a similar rating. So what will happen? You can imagine that the new investor is more interested in a 6% loan every year. So if investor A wants to sell his bond, he may receive less money that he was paid for his $1,000. But when talking about bonds, we don't talk in dollars, but we talk in percentages of the original price which you purchased the bond. So if investor A bond drops to $950 in dollars, that's a 95% of what it is originally, right? In short, the price of a bond on the market changes depending on how attractive it is to investors at that time. And when interest rates rise, this has a negative effect on existing bonds. But when interest rates fall, this has a positive effect on the bond of an existing investor. And this is what you often hear in the news. The price of a bond can fluctuate in the meantime. And this scares people because they don't get it. And then the next thing, because the bond is issued at a price of 100%. And in the meantime, the price can fluctuate. But when the bond is redeemed, the price at the end of the term always returns to 100%. So if you hold the bond from the first example, you know that you will receive your $1,000 back in full plus interest with certainty. Unless the company or the country where you lend your money goes bankrupt in the meantime. Ultimately, the price of a bond can fluctuate in the meantime on the secondary market. But at the end of the term, the price always returns to 100% of the nominal value. This means that at the time you will receive the borrowed amount plus interest unless the issuer goes bankrupt in the meantime. In the next video we will compare bonds to a fixed deposit. And if you have any questions about bonds, please share your comment below and I will try to answer your question. Take care and see you in the next video.